Redcloud Financial Services is your preeminent source for mining industry opportunities. The team provides a unique, tailored marketing program dedicated to reaching the right people from its mining-focused global network, giving clients access to industry-leading events and conferences, retail and institutional marketing, plus an in-house growth-driven digital agency. Redcloud Financial Services has access to some of the mining industry's most notable companies and CEOs.
We're talking to Mike Alkin, the CIO founder of Sachem Cove Partners, and we're going to be talking about uranium. You're definitely going to be hearing more from him than from me. Uranium, nuclear as well. So let's get into it here, Mike. Thanks again for joining us. And as mentioned off the top, which you didn't hear, I'll say it again. We are taking questions. Put them in the comment section, please, on the right-hand side of your screen, and we'll get to as many as we can. Mike, you said that you like to examine the conditions in the uranium market, and that creates catalysts. So we've got contract prices, according to you, a little while ago, but at about 15 to 17-year highs. We've got the spot price for uranium around $71 a pound US. So how would you describe current conditions right now?
Conditions, depending on what you're focusing on. I mean, if you're focused on where value is created and you're looking over a cycle, conditions are as good as they have been from a supply-demand standpoint, right? So as you mentioned, the term price, which is the fixed price of a long-term contract, is at $80 per pound as reported, and that is at cycle highs and going back 16, 17 years. And it's been holding steady there. And that's on last year volume for long-term contracts. Mark, we're down in the close to 25-30% as utilities had come off a fairly robust but not quite replacement rate year in 23. In 24, they stepped back a little bit. I think for a couple of reasons: is they were still contracting further downstream at enrichment and conversion, but also I don't think they liked the prices. I think they felt that they went too far too fast, and they tried to step back a little bit from the market, and yet pricing went up 16, 17%. And as you know, you show me a commodity where volumes can go down double digits and pricing goes up double digits. It rarely happens. So while the utilities are busy and preoccupied focusing on the downstream conversion and enrichment, where there is more capacity tied up in fewer hands, they were trying to sort that out as Russia controls a big portion of both of those markets. There definitely was a cohort of fuel buyers that felt as though they didn't want to pay those prices, and they wound up paying 16, 17% more. So from a long-term fundamental standpoint, the business is characterized over 80% of pounds traded in a given year are long-term contracts, and so that is very healthy. The spot market, you would have seen the spot market, at one point in time in 2016, 2017 was $70. And then you saw it rally up just a year and a half or so ago up to $106. And then it backed off into the low 60s. And now today it sits in the low 70s. Much smaller market, I'm not going to say it's not important, but it's more discretionary if there are some pounds coming in from offtake that go into the traders. The traders dominate that market. They account for 2/3, 65, 70% of the pounds traded in the spot market are traders just moving pounds back and forth. The utilities are a very small portion of that. As a matter of fact, the utilities, who are basically the only consumer of uranium, absent the military, but that's small, but the utilities are the main consumer of uranium. All of their purchases in the spot market account for about 4% of the total consumption that they use in a given year. So from a fundamental standpoint, supply is beyond tight. There are structural deficits in the market. Demand is unprecedented with what we're seeing. So I think it's structurally a supply-demand deficit that someone who is bullish uranium would like to see.
And we will have you expand on a number of those points as we go through this show, especially the utilities with egg on their face, as you like to say. And we'll circle back to that and to some other points that you made there. Now, just in the near term, you've said that the uncertainty created by the White House globally, in many respects, has left market participants in the uranium market feeling raw. What do you mean by that? Can you elaborate on that comment?
So I think what happens is, I mean, with the tariff talk, there's certainly a portion of fuel buyers that are not sure what they're going to do. What are the tariffs going to do? Do they have material sitting in the U.S. that they need to send elsewhere outside the country to get enriched? And then what happens? Does it get hit twice? So there's always some uncertainty. But what I think you tend to find, though, is folks are looking for reasons why. Why isn't contracting accelerating at rapid paces? Why aren't prices going through the roof? These are. It takes a while. It takes a long time for these decisions to get made. And again, it goes back to the White House creates uncertainty. Yes, right. But you can live through that. Where is there going to be another Russian ban? Right. There's already a Russian ban coming on material coming at the end of 2027. You're going to see it phased out. Russian enriched uranium, which accounts for 25% of uranium that's in the market. There's another Section 232 hearing, uranium part of that, on the grounds of national security. What's going to happen there? Again, more uncertainty that comes into the market. But at the end of the day, when the fuel buyers need to procure this uranium, because the uranium cost is a rather small percentage, single-digit percent of the overall cost, the front end of the fuel cycle, uranium conversion, enrichment, fabrication is in the 20-25% range of the total operating cost of a reactor. But the uranium is a single-digit percent, and they will pay what they have to pay when they need it. They're in their contracting. They're not contracting at replacement rate yet. The White House and tariff uncertainty creates some. Section 232 creates some. But at the end of the day, when the fuel buyers decide, and it takes one, right? That's what you're kind of waiting for. You're not waiting. This cycle that everyone seems to be waiting for. They want to see this dramatic rise in pricing. That again, we're at 17-year highs on the term price. So that's pretty good. But if you're waiting for this massive spike up, where that could occur is people look for catalysts. I don't look for catalysts. I look for conditions, because I can't figure out what the catalysts are. I look for the conditions that are going to drive prices, that go parabolic. And I think that the conditions are ripe for that. Really tight inventory levels, really tight mine supply. There are structural deficits of at least 20 million pounds in the market right now, rapidly accelerating. New mines that are coming online over the brownfields that have been coming on can't get out of their own way. They're producing less than half of what they were supposed to produce. So those conditions are such where it's not going to be a major global utility that is caught off guard. That, oh my gosh, we can't run the reactor. They've got a few years sitting around. They've got pipeline inventory, but that's just a small portion of those. That's a portion of those. It's the utility with one or two reactors that's been complacent. And I live in this fuel cycle. I've been living in this fuel cycle since 2016, 2017. The complacency is unlike anything I've ever seen in any walk of life of doing this for over 30 years. It's a cohort that you can't tell anything. You can't show them numbers. You can't do whatever. And why? Because they're not incented to know. They pay a very small, they're not financially incentivized to get it right. The buyer doesn't keep any of the upside if you bought it well. So and it's a small cost, so they don't get fired if they paid up for it. They get fired for not having it. But because they're so infrequently, they're buying 5, 7, 10-year contracts. When the uranium is needed, they go buy it. And so it's going to be, the conditions are such where it's so tight in the contract market, again, there's not enough viable economic supply, as witnessed when volumes are down almost 30% in 24 in contracting. Pricing is up 16, 17%. Why? Because those who did contract found that the producers said, yeah, sorry, pound sand. This is what you're paying. And again, that's on the term price, Mark. I got to be really clear about that. For those who, I'm sure many do know, but some might not know, there's different contract prices. long-term contract pricing that's reported is a base escalated. It's a fixed contract price that escalates, about inflation every year. It's delivered in the third year from the date this contract is signed. And that's what utilities want to pay, and that's what they will pay in more of a bearish market, or a market that is a little bit more balanced or whatnot. And that's some of what's signed, but way more of what's signed starting to see right now are market related. That's where the producers say, you know what, we want part of the upside here, because there's no real futures market to hedge this stuff. It takes place in the bilaterally negotiated and bespoke conversations between utilities and producers, and that's where today. If you are, with the price of $71, if you are a producer, you're going to get $60, $65 floors. You're going to get $120, $25, $30 ceilings. So you're getting $80, $85, 85% upside and maybe 15% downside. Like, sign me up for that all day long. And that's while you're waiting for this one or two reactor utility somewhere who wasn't paying attention, that we see and know about all the time, that's going to get caught off sides. And something's going to happen, a missed delivery, some sort of condition that's causing something to not get shipped, a mine that couldn't make a delivery, and then that sets it off. So again, not one specific thing, it's all the conditions that make up that environment that we're in right now.
Mike, further to your point about utilities and the prices they're paying, you're saying that a lot of them have egg on their faces because they didn't buy at a certain price a while ago, and they're pissed, to use your term, at the prices they have to pay. And second part of that is, you mentioned complacency. I was under the impression that certain people that you've been talking to have come around to your way of thinking. Are you not really seeing that?
Yeah. So when I say, they don't even have egg on their faces, they don't care enough. They're really smart people. Let's get this straight. They're nuclear engineers. They're not market creatures. They're not traders, right? They're not in the market discovering price. If you buy a 5, 7, 10-year contract, how often are you in the market? Very infrequently, right? Charlie Munger, show me the incentive, I'll show you the outcome. They're not incentivized to pay a certain price, to buy low and sell. They're not selling high, but to buy low, right? So, they're contracting, but if you look at the amount of uncovered, meaning demand that's in the future, that is not under contract yet, you start to get out, you look out 15 years, you're well over north of £1 billion. You start to come in a decade, you're several, high hundreds of millions of pounds. These are material amounts of uncovered requirements, and the mines don't even exist yet for that to be covered. So you're talking deficits, structural deficits of between 15 to 30 to 35% of their annual consumption around the corner. But they've been playing it close, and footloose and fancy free. They've got a few years worth of inventory. Big whoops. But so what you would expect to see, Mark, in a normal functioning market, and make no mistake, the uranium market, the reason that we're here and investing in it is because it's dysfunctional, it's broken, the incentives are misaligned, and it's not even a market. It does markets a disservice to call the uranium market a market, right? It's infrequent price discovery, it's completely opaque. It's an over-the-counter market with bespoke contracts, with unincentivized buyers, with traders who come in who have no balance sheets, who flip pounds around once in a while, that the market thinks is the investment market thinks is the market because it's quoted once a day. But that quote once a day is at 2:45 p.m. and it's based on a midpoint of a bid and the ask. The trade didn't have to move. So traders who have offtakes coming in can move the bid and the ask around if they want, and they do. And so you can have kind of like a little bit of a bullshit price sometimes. And then they're focused on the term price that gets reported once a month. But the price reporters choose not to report the market-related prices. And what are the market-related prices? That's where the real money is being made right now. That's where the producers are. That's where the rubber's meeting the road, right? Where floors and ceilings. So this market is completely dysfunctional, which is wonderful for an investor. So what should they be doing? They should be contracting at a replacement rate. You use a couple of 100 million pounds a year of uranium, you replace that amount. But what winds up happening is over the past several decades, you've had a few events, right? You've had 3 Mile Island, you had Chernobyl, you had Fukushima, right? And so after you've seen demand pull out, and what wound up happening was you had inventories build up. So if we go back to Chernobyl in the mid 80s, all of a sudden from 1990, 91, 92 up until 2004, you saw utilities replacing about 35% of what they would use, right, in a given year. And what were they doing? They were drawing down inventories. Made sense, because all of a sudden, after Chernobyl, the world kind of freaked out. Nuclear slowed down to a grinding halt. And so supply was coming. You had excess inventories, and that made sense. And so utilities drew down the inventories. They drew down, and all of a sudden, like anything, especially in a market where price discovery rarely occurs, complacency kicked in. And so that 35% a year, 33, 35, 37, all of a sudden in 2005, you woke up one day and the utilities wound up at that point in time, they were consuming 170-ish million pounds a year of uranium. And if you looked at all the forecasts and you looked at all the industry forecasters and all the experts in the industry, everyone was saying, continued uncovered requirements are still very low. You don't need to worry about it. There's inventories out there. Meanwhile, starting in 2000, the price had bottomed at about $7 a pound. And by the time you got to 2005, it was sitting in the mid 40s-ish or so. So now you have a price that also went up 6x in anyone's world. That's a bull market. But if you read all the commentary at the time, everyone would have said, it's really not a big deal. Until all of a sudden on that 170 million pounds or so of demand, 250 million pounds were contracted. So what does that mean? That means their replacement rate was 1+, right? And then all of a sudden for the next several years, they were replacing at 110, 115, 120, 125% of their contracted consumption. And it was like trying to put a pig through a python, and prices went parabolic. And so what you saw 2011 comes along, Fukushima goes down in Japan. Japan's reactors, 54 of them, were 13% of global nuclear power demand. Well, all of a sudden, they pulled over the next 2 years, all those reactors went off the grid. So what happened? Inventory piled up. And what did you start to see in 2013 through 2022? You started to see replacement rate contracting at about 35, 36, 37%. So what were they doing? They were drawing down inventories. Makes sense. Again, complacent group, not financially incentivized to really dig deep into it. They don't get fired for not paying low price. And so in 2017, 2018, when we started doing the math, 2016, 17, saying, wait a second, there's not enough economic supply, and that inventory is starting to wear down. You need to start replacing this at a much higher rate, and prices need to move a lot higher from $17 in the spot market and mid-20s in the contract market to a lot higher, right? The average cost to pull a pound of uranium at the ground at that time was in the mid-50s. Now it's mid-70s to 80s for the average around the world. So all of a sudden, what have you seen? You haven't even seen replacement rate contracting yet. Why? So now the inventory levels, whether it's in the US or Europe, the inventory levels, if you look at them and you start to look at the Koreans in the Japan, you look around the world, you start to see in the US, they're 2 years or a little bit below. In Europe, they're about 3 years. That's yesterday in the world in uranium mining. That's nothing. That's enough to get you a fuel load, right? So that complacency is there. Now, they contracted 160 million pounds in 23 on what looked like 190 million-ish pounds of demand. In 2024, it was 120 million pounds, right? As I said earlier, they went on strike a little bit. They were focused downstream on other things. They weren't really sure. They could hide behind and blame some other stuff. Yet if you speak to that same cohort, that's those same fuel buyers who are now paying $125 ceilings and paying $60, $65, maybe even $70 floors, depending on what's negotiated, and are paying $70 when they could have been paying mid-20s, that same fuel buyer and buyers will tell you plenty of uranium out there. I don't care what they say. They've proved to me at $17 when I was standing up in front of them at nuclear conferences telling them you got to start buying, and they told me I was absolutely moronic and had no idea what I was talking about. They told me that in 2018. They told me that in 2019. They told me that in 2020. And all prices have done is continuously go up. So they will get there. If you look at the inventories are so tight, and then I don't, people say, oh, the spot market, yeah, well, why is the spot market down? Because the spot market is tiny, small discretionary pounds. It's a sliver of what the world is consuming in those reactors. And like I said, the utilities are 4% of all consumption is bought in the spot market. So the fuel buyers, they're coming back to the market. They see what's out there. And again, the big ones in the US, the big ones in Europe, they're not getting caught asleep, right? They know what's going on. They're contracted out till 2029, 2030, because they've fallen into the trap to think that, all these big mines that are potentially out there that haven't been financed, permitted, built, or anything, they'll come. Forget the fact that if they come, there's still significant deficits. But the chances of them coming on time, anywhere near on budget, which will push everything out, are in the world of mining, as people who know mining, is almost none. So you're looking at significant deficits. They're starting to wake up to it. They're paying higher prices. So they could say whatever they want. They could contract whatever they want. As prices move higher, that's the truth teller. And that's so, yeah. But, as far as fuel buyers chase things, they don't anticipate anything.
Wow, you were on quite a roll there. Yeah, I was going to say, have a sip of water, take a breath. That was a brilliant insight. I just want to keep that going to a degree. When you talk about this complacency and investors' tendency to fixate on the spot price, what kind of opportunities has that presented to you, and does that present to you as an investor?
It does. It creates both opportunity and short-term, not challenges, but you have to be aware of it, right? So investors, and you even hear about it with sell-side analysts, many of them, where they'll hold a conference call and they'll talk about, well, pricing's been weak, pricing's been down. What are you talking about? On what planet are you actually an analyst? Because if you knew where value is created, as we just talked about, the term price, that's where the value is created for these companies. And again, the spot price is there. So, when we think about price and we're thinking about pricing, you have to put it in context. And so for us, the spot price creates just a little bit of sentiment noise. People get very depressed, and it affects the equity prices too. So obviously, right? So the correlation is quite high. So when spot pricing goes down and equity prices sell off, if the term price is going higher, one could argue that creates pretty good opportunity to add to what you're doing. I understand how people might not feel that way. I understand how people might not have that conviction. I can't help them for that. I can't figure that out for them, right? We do what we do. We know where value is created. We think we know where value is created. So we like to think of sell-offs as opportunities, and nothing goes up in a straight line. So the spot market plays a big psychological role for people. That's unfortunate because they should be looking to the term market. Not to say the spot market's insignificant. In 2012, 2013, 2014, when there's a lot of pounds floating around, that's the real supply demand that's going on. Even though it's not for contract demand, it's suffocating price. But like right now, there's not a lot of volume in the spot market. So it's just discretion. It's just some random pounds floating around.
Let's keep it going with equity prices and uranium equity stocks. We'll use Cameco as a proxy. The last 5 years, the stock is higher by more than 430%. It peaked in December of 2024, followed by about a 40% drawdown. And yet in the last month or so, it's up more than 30%. So can we read anything into that? Are investors picking up on something, some conditions perhaps in the last while?
I think what's happening is, you have to, I remember several years ago, people saying, wait till the institutions come, right? And it was mainly a retail-driven investment theme, because the market cap of the industry is so small. And what you've seen over the last handful of few years, more institutional investors come into the sector as the market caps have grown. It can attract bigger capital, bigger pools of capital. But they're not just going to come in and just buy blindly. They're going to, some want development companies, some want producers. And so you've seen more interest come into the sector, but it also brings short interest as well. It's not just, people don't just come in when institutions come in. They don't just come in and say, oh, I'm going to go buy uranium. They're really smart people who come in with a different view, right? And they might come in and review. What we've noticed over the last couple of years is you've had a cohort of investors that have come into the space that want to short uranium because they see the spot market and they see it coming down, and maybe they don't have the conviction we do in where value is created, and they see the opportunity that there can be short-term profits made in those things. So when they see spot selling off a little bit, they're going to go short some positions, and then you take that hurts sentiment. Cameco is no more immune to that than anything else, right? Because you might have some big funds come into this sector. You're a big long only fund. Let's keep the hedge funds out of it for a moment. You're a big long only. You really like the nuclear theme. It makes sense. How you're going to play it? Well, you're running several $1 billion. You're going to buy Cameco. Right? It's even hard to buy the ETFs because they're not big enough. So you're going to go buy Cameco, and then all of a sudden you're in there. You think you like the theme, but you're covering myriad industries. The theme makes sense. The thesis makes sense. You're in there, but you haven't really modeled out all 400 and some odd reactors. Most of the sell side hasn't either. Right? They're cutting and pasting some of the forecasters out there. There's a couple that don't, but most do. And so all of a sudden, you start to see the spot market sell off, and you've looked at other commodities, and mostly the market prices are not deceptive, mostly, but that's not this. This is opaque. It's over the counter, and it's a bullshit fake market, right? It's not even a market. So all of a sudden you get a little spooked, and you start seeing sell off, and they don't need it. You've got a few percent, 5% of your fund devoted to that, 7%. You got your PM breathing down your neck. You can't really defend it because the spot price is going down. So what do? They sell it. Well, ultimately, we think the way we view it, again, the conditions are such where there's so much positive news flow on the demand side. We know the supply side is a mess and a half. We know prices need to be materially higher. And we just feel that there's enough momentum there to create the conditions such that ultimately something's going to recover, right? So why did it move down 40%? Because wonderful, beautiful liberation day, as Trump would call it, took the stocks down, right? So you're not going to sit there and fight that battle, climb that hill as an analyst when your stock's getting pummeled. Clean it out, just sell it. We get that. That's what happens. The shorts are going to have a field day, right? They're going to do that. They're going to stare at spot. They're going to talk about spot that was running low on money at one point. You're going to have to sell into the market, and it's going to blow up the whole trade, right? We go to idea dinners in New York where you get a bunch of hedge funds sitting around and you hear them talking about that. That's fabulous. That's music to our ears. Okay, Mr. Hedge Fund, who I could tell really doesn't know the supply demand, but you're playing the spot has to sell some pounds into the market. It's going to blow up the trade. I'll take the other side of that trade against you all day long, which we did. And we do. But that's fine. That's beautiful. That makes markets, bulls and bears. That's really healthy. So I forget where we were going. Cameco. So as the theme keeps getting more and more, it's permeating. One of the major investment banks came out with a research piece this past week that was spectacular on nuclear, the nuclear playbook. It was a wonderful piece that highlighted the structural deficits that most investors don't see. Certainly the utilities don't, because the price forecasters are out there don't show, or the industry forecasts are out there don't put it in that context. So you take advantage of these sell-offs, and like a company like Cameco, in the Western world, and we don't recommend stocks, we don't talk about stocks, but I can't think of a better positioned company than them, right? Across the value chain. So, that's not a recommendation to do anything, but yeah. So, you have to take advantage of these pullbacks if you're interested in seeing what the real value of these companies are.
That was great, Mike. I love how you pull back the veil there on some of the dinners and conferences you go to, and the things that you hear from hedge funds, and the opportunities that you see.
And Mark, it's not just supply demand driven, right? These are, if you're running it, if you're at a hedge fund that's more siloed, and you might call them pods, right? Really smart guys, but they play a different game. They're not playing the, hey, we're going to look at it over a year, which is fine. They're gonna go where they can capture, in their view, the most alpha in the shortest period of time. So that's wonderful. So they're going to have a different view, and they're going to focus on the spot market. And all of a sudden, spot gets priced now. There was a spot raised capital at a little at above where it was trading, right? And so the bears will say, "Oh my God, look at that! People paid up for that. Holy cow!" Well, why would they do that? That shows. Well, it takes away for a year plus that spot's going to sell pounds in the market. So then they'll maybe find something else to latch onto or not. But ultimately, the fundamentals win. In the short term, it moves the stocks around, and I get it. And these moves are pretty dramatic at times. So this is not for the faint of heart. It's not for somebody's. If you're not wired to handle the volatility like that, which I completely understand, then you shouldn't be investing in these names, because you're going to get a lot of drawdowns and a lot of crazy moves up.
Shifting gears slightly, when you compare and contrast the last big cycle in uranium about 20 years ago, you've said that inventories are actually lower now than they were then. Can you expand on that a little bit?
So context is really important. So if I were to go back and look at the inventory levels of the U.S. utilities, let's use them. They're almost 30% of world demand, and there's data that's out there that you could get from the agencies. And you would look back and you'd say, 2004, 2005, the inventory levels were not much, but a little bit lower. They had in the 90s of millions of pounds, and depending on when you looked at it, you could have looked at the U.S. and said, they had 110 or 120. Let's put it in context. They use 45 to 50 million pounds of uranium per year in the U.S. And so if you had 90 or 110 million, 115 million pounds, not that big a deal on a couple of years. But, looking back then, though, what they would show, and that was utility inventory and supplier inventory. And you can see the same now, utilities plus suppliers. And they'll report it. And these are just surveys, right? So, they're ballparks. But so you would see a little bit lower inventory back then at the bottom. And now you'd see inventory and say, well, wait, it was a little bit higher. But what that completely does not include was the megatons to megawatts program. If you were, and that is where the United States and the Russians took down, the United States imported about 20 million pounds per year from downblended nuclear material from the Russians, because the U.S. did not want uranium floating around on the black market in the world. So they committed to taking in that 22 million pounds a year. And so if you, from 1993 to 2013, that program ran. So if you were a U.S. utility, you knew that almost half the demand was coming in. And so there's no chance that you didn't need the amount of inventory. When you take that, go back to 2005, and say, okay, from 05 to 13, 20 million pounds a year, guaranteed coming into us, times the next 8 years, that's 160 million pounds. Now put that on the 2005 number and see what that looks like. That was an off-balance sheet asset for utilities that it was peace of mind they didn't even have to worry about. So now that doesn't exist, right? Kazakhstan at that time was just starting up. Kazakhstan was at 6, 7, 8, 9 million pounds a year. They'll produce 65 million pounds a year this year. And they went from mid-single digits millions of pounds a year over the next handful of years. They were up at 56 million pounds a year. That doesn't exist right now. So you don't have those. Yet the inventories are at or below the levels that they were back then. So with the cavalry, as some might say, and would be some of the new development mines that will say they're coming online in 2028. I mean, do the math. What mine comes online on time, on budget? They'll be way extended, and it's going to be into our view is early 2030s. So if you're a utility counting on those pounds, good luck. You're going to have to, not only are you facing 20 plus million pounds, that's growing every year, deficits, but now push those other pounds out there and start adding 20, 25, 30 million pounds a year to the already deficit, because you're going to have to wait another 3, 4, 5 years longer than you thought you did if they get built. Because if you think about the big development projects that are out there that haven't been permitted, haven't been fully permitted, haven't been licensed, haven't been financed, haven't been built yet, right? It's a lot of steps you got to go through in an industry that's notoriously can't put 2 feet in front of each other when trying to build a mine on time and on budget. The strategic value of some of them. If I'm one of the bigger mining companies, a pure play uranium company, or a bigger multi-strat, major mining commodity mining company, especially if I'm a pure play, I have projects that are coming offline in the mid 2030s. I could fit one of those mines, one of those projects right into my development pipeline. So instead of coming online and said 2028, 29, 2030, now all of a sudden it's 2036, 2037. Now what happens to those pounds? So there's so many different things at play right now that I don't think the market's appreciating.
Okay, Mike, one more question from me, and then we'll get to some questions from some viewers. You've said in terms of M&A that there are some tremendous strategic deals that could take place, but maybe the conditions aren't quite right now. But so what market factors need to change before we see some more M&A?
You never know. You could wake up one day, who knows? You do the math on some of these things and they're very doable. So it's attitudinal. You don't know when stuff like that happens. So I don't know. I just know the conditions are such that strategically, in some instances, it makes immense sense. So on that side, it makes immense sense. Financially, it makes immense sense as part of where it would fit if I'm a producer and I want higher prices, it makes sense because I don't have to bring those pounds on right away. Then it really just comes down to is that being priced in by the market? I don't think there's a shot. It's being priced in by investors, or that's being priced in by utilities. Certainly not utilities. But when, I don't know. If and when, who knows? It just makes, when things tend to make so much sense, they eventually happen. We think of it more as not a floor, but we think of it more as, okay, there's a price where certain assets would get just too stupid that then somebody's going to come in and take care of it because there's too many big entities that need this stuff.
Okay, Mike, a question here from John Quake. So what role do enrichment and conversion prices play as signals to uranium equity investors? And what are those prices telling us right now?
Enrichment and conversion are services. Good question, John. Are services. And services aren't needed without the product. And so, if you look about, you go downstream to upstream, so fabrication at the bottom, and then you move up a little bit, and you get the enrichment. Fabrication is putting it in the fuel rods. Move up a little bit, you get enrichment, and you move up, you get conversion. Well, enrichment is where the magic happens, right? Without getting into the science of it, because I really can't get into the science because I'm not a scientist. I understand how it works, so I couldn't talk too much in detail. But without enrichment, there's no reactors working. Unless they're Canadian CANDU reactors and all that stuff, but that's a small number of reactors. So the Russians control 40 to 45% of that market. So when the Russians came out of that market, capacity tightened, and you saw prices move up. In conversion, they control in the mid to high 20s. Same thing happened. They control mid-teens percentage of enrichment of U3O8. But there's the signals it sends, as John's question asked, is there's such tight capacity in enrichment and conversion because the utilities are trying to contract at replacement rate. Well, the economic viability of the pounds that exist, economic viability, forget all the nonsense of, there's so many pounds of uranium. That's nonsense. It's economically viable pounds at the actual all-in sustaining cost, not the glossy bullcrap numbers that these companies put in their presentations. That's where you will see significant increases, in our view, in the prices to have to come into line. And why? It's the same test. It's the test that enrichment and conversion, lack of economic capacity, Same thing's happening in uranium. Lack of economic capacity. I go back to what I said earlier. Volumes down last year, prices up in the high teens. That doesn't happen in a commodity market. Volume down, price down, volume up, price up. That disconnected last year in uranium.
Question here from Stephen Smith. Should Western utilities be concerned that most of Kazatoprom's production will be heading east?
Sure. They should be. Good question, Steve. They should. And are they? Some are, some aren't. Again, many of them are asleep at the switch. The big guys aren't, but the big guys don't buy all the uranium. And it takes one to panic. That's what you're playing on here, right? And we've got a long history of knowing this cohort. And the complacency is staggering. That's what I can tell you.
All right. And lastly, any final words? I know you don't give stock picks, but any advice for anybody who's maybe already involved in the sector or wanting to get involved in the sector, how to go about it?
I mean, it's a different beast. I mean, I've been doing this over 30 years as an investor, not in uranium until 2017 or so. So I've not encountered anything like it. The opaqueness, the complicated nature of it, the broken nature of it. Again, it all creates, it's easy for me to sit here and say, it creates great opportunity, buy the dips. Like these are stomach churning dips, right? What gives you the ability to stand in there and take it on the chin is a position sizing. Understand you always have to live to fight another day, but also having the fundamentals and understanding the fundamentals. So, if you're not wired that way to begin with, this is a tough investment, right? If you're wired to just like things that are more positively inflecting at most times, this is the wrong place to be. You probably, I laugh sometimes, with the guys who work for me and family, probably 80% of it, I don't know, I'm making it up, but it feels like 85% of the time, you're fighting an uphill battle. Then all of a sudden you have these monster periods that far outweigh what you feel like you're fighting in things. So it's, they far outweigh it, but you got to understand that that's going to happen. You don't have to understand anything. You don't have to do it, right? And if you can handle that, then don't do it. Don't be invested in space or take a tiny. Everyone should, in this sector, you should always have a small portion of what you're doing in it. It should never be a big portion of it if you're doing it at home. So it's again, and I get sick of hearing myself talk. That's why I don't do many of these anymore. Because there are times where, I'll see sometimes, I don't go on Twitter, but very, very, very infrequently, and somebody flags something out to me and say, oh yeah, well, it's never gone up. Prices, I've been investing since 21 and I've lost I don't know how, right? Unless you got out at the wrong time, right? Or I've been investing since 2017, I made money. I don't know how you did that, how you're not materially ahead if you did. So you got to know yourself. Is what I would say, and understand to buckle in because the volatility is stomach churning at times.
All right, Mike. Yeah, we had a couple of late questions come in, but we're pretty well at time here, so we'll wrap it up there. It's suffice to say that you are easily one of the most knowledgeable in the uranium sector, and that was a huge education. We really enjoyed that. Thanks for taking time out of your day today, Mike. We'll talk to you again.
Thanks, Mark. Always my pleasure. Thank you.
Okay, Mike Alkin, CIO, founder of Sachem Cove Partners. Apologies to Igor and Jeffrey. We just ran out of time there for your questions, but we appreciate you participating. Thanks so much for watching. We'll see you soon. Take care.